Welcome to my channel. So, as you might know from my introduction video, my name is Shreya and I would be teaching or revising economics on this channel. This is a series where I give you video notes of this subject as in economics, and this would be around 30 to 40 minutes depending on the chapter or the unit. It may be longer or shorter. So today I'm going to be doing money and banking, which I find it personally the easiest chapter in the whole 12th economics. So the most basic definition in this chapter of what is money. So, money is basically something that is widely accepted as a medium of exchange that helps us trade goods and services without the hassle of barter system. So, why was there a need to develop a concept such as money? Who decided to give a piece of paper, something is a value? Okay, so there was a system. Our economy was basically a commodity to commodity exchange system, which is also known as barter system. So in that system we used to trade goods for goods. So if a person needs 1 kg of potatoes, they would go and trade it with someone who needs um, let's say 1 kg of rice. So the person 1 would give rice to the person 2, and person 2 would give potatoes to person 1. So what was exactly the problem in that system of economy? Okay, so first there was a lack of double coincidence of wants. So as let's take this example again. This person wants, I want a kilogram of potato, but I want to trade it with someone who can give me 1 kilogram of quality potatoes, but that person doesn't want 1 kg of rice from me, or vice versa. So that was a problem for like barter system. But right now, since we have money, we can just give money to them and they can just give us the commodity we need instead. The second problem was lack of divisibility. So in the previous ages, we also used cattle as a means of currency. Like imagine trading a cow for a house. Oh my god. Okay, so there was a lack of divisibility. So you can't. The value of the cow or the value of the house would not be exactly equal, but you cannot cut either of it in half either. So there's that. Then there was a difficulty of storage in wealth, where basically you can't, if you define your basis of exchange from commodity, you can't obviously store it for a long time. Then there was an absence of common measure of value, which is also kind of related to the lack of divisibility. Then there is a lack of standard deferred payment. So like if you took a loan from someone, right, there was obviously no money, there was no currency involved. So basically when you take something from the other person, you would be like, I'll pay you back later, but there was no actual measure of like what exactly do you have to pay them back later. So that was there a problem. So there was that. Then the money evolved eventually. So now we come to evolution of money. So there are basically 6 types of money till date. Starting commodity money, which is barter exchange again. The examples are leather, pearls, salt, cattle, anything you can think of. And then came metallic money, the copper and gold and silver coins we used to trade in the older ages. That was metallic money. Then came paper money, the currency notes we credit money, that's known as deposits, withdrawals, checks, drafts and stuff. Then came plastic money that made the currency system more efficient. The plastic money is basically cards like debit cards, credit cards, Visa, etc., etc. Then came digital money that we use now, that is digital payments like phone pay, UPI, Google Pay, and stuff. So, coming to a very important topic of this chapter, the basis of this chapter, meaning and functions of money. So, there are 3 points that define money. There is no exact, solid definition that fits into the um, like the definition of money, but there are three statements that can help us understand money better. So, first statement is money is what money does. Second statement, money is a thing that possesses general acceptability. Like if someone gave you money, it's not like you wouldn't accept it. So, money is anything widely used as a means of payment and generally acceptable in payment settlement of debt. Money can be used from anything to buy a ship, to buy a sheep, if you get it. So, there are four basic functions of money in this syllabus, in our syllabus for this year. That is, money has actually three major functions: a primary function, secondary function, and a contingent function. But contingent functions are not in our syllabus. So the primary functions of money are medium of exchange and measure of value. Secondary function of money are store of value and standard of deferred payment and transfer of value. Okay, so there are some types of money that sh- um, I would like to explain. So, first type of money is fiat money. It refers to the money which is issued by order of the government. It includes coins, currency notes, and yeah, that's it. Then comes fiduciary money, which is money backed up by trust. Like there is no real currency involved in that, but it is backed up by trust, and its examples are promissory notes, commercial papers, bills of exchange, all that. There is a there is a rhyme that would help you remember the functions of money better. So it goes: money is a matter of function for a medium, a measure, a standard, a store. So, a medium and a measure refers to the primary function of money, and a standard, a store refers to the secondary function of money. So, you can easily remember it with this statement. Now, we come to money supply. What exactly is money supply? Money supply is the actual stock of money held by the public at a point of time. Okay, so where the definition says this is a concept where we define the stock of money held by the public at a point of time. When there is a concept of money of point of time, so a point of time refers to a stock concept. So basically, money supply is a stock concept. So, what exactly do we include in public? Public means private individuals, business firms, and money supply includes money using sector and it excludes money creating sector. So, what exactly does this mean? So, there is a little flow chart that I would like to show you guys. I hope you can see this. So it basically says that public, the definition in the money supply where we refer to public, it actually refers to the money using sector, which is household and business firm, and it excludes money supply excludes money creating sector, which is RBI, commercial bank, and the government. The money supply of an economy at a point of time is the total amount of money in circulation. So, that is the total amount of money that is actually circulating in the economy and not totally held still at a point. So, there are two components of money supply, that is currency components and deposit components. The first component, currency components, is consists of coins, currency and paper notes, and deposit components consist of bank deposits uh, against which checks can be issued, that are savings deposit. Money supply does not include term deposits because it is held by the commercial bank and it cannot be withdrawn at any point of time as per the demand of the general public. So there is a very important question that goes, what are the components excluded from money supply? That are the amount of coins and currency held by the commercial bank as their cash reserve, the stock of gold held by the central bank, cash held by government in treasury and central bank are excluded from money supply. So there are four measures of money supply, that goes M1, M2, M3 and M4. M3 and M4 are broader concepts and M1 and M2 are narrow concepts. And M1 is the most liquid measure of money, and M4 is the least liquid measure, and M1 is the least comprehensive, and M2 is more comprehensive. So let's go to the formulas to find the money supply by each measure one by one. So M1 includes components like CC, DD and OD, where CC refers to the currency held by the public, DD refers to the net demand deposits with commercial bank, and it does not include interbanking claims. OD refers to the deposits with RBI. So when you add all of these components, you get M1 measure of money supply. Then we go to M2, which is M1, the whole CC plus DD plus OD. Plus, there is one more component, that is saving deposits with post office savings bank. Then M3, that is also M1 plus net time deposits with bank. That is again CC plus DD plus OD plus net time deposits with bank. Net time deposits refers to the total bank demand deposits after subtracting any balance due from the same bank to other institutions. And M4, the last measure, is M3, which is M1 plus net time deposits with bank plus total deposits with post office savings bank. That it is basically an addition of all three measures of money supply that we read earlier. Okay, so what exactly this component OD is, like the other deposits with RBI? These are basically the deposits of quasi government institutions like Industrial Development Bank of India, IDBI, International Monetary Fund, IMF, and World Bank with RBI. That the money that these quasi governmental institutions have kept or preserved in RBI. Okay, so I told you about the difference between M1 and M4. Let's go to the next topic, which is what is high powered money. This is another type of money like fiat and fiduciary money. High powered money is the money produced by RBI and the government. It consists of two things: currency held by the public and cash reserves with the bank. Legal tender money. This is another type of money. The legal tender money refers to the money that can be legally used to make payments of debts and other obligations. Legal tender money is all the currency notes that we use that are all legal tender, and as you know, demonetization removed those currency notes as legal tender. So that is what legal tender is. So there are two types of money that are very much important. So small concept of intrinsic value of money, which is the actual commodity value of a thing. Like the paper itself doesn't hold a value when before it is converted into money, but after it is converted into money, its face value increases. So that is first type of money is credit money. Credit money is when the intrinsic value of the money is lower than the face value. It is just as our currency notes, because the paper, as I said before, the paper itself doesn't hold any value, but the face value of money is like way higher than what the value of commodity is. Then there is full bodied money, where the intrinsic value is equal to the face value of money. That is, you remember the type of money, the second type of money that we studied, like in the evolution of money, the metallic money. So there, the silver and copper, all the other metal coins, it used to hold the same value, as much value as it was, like as it itself was. If the copper was of 100 rupees, the the coin was also of 100 rupees, so its face value was equal to its intrinsic value. So that is full bodied money. Now we are done with the first chapter of this unit, that is money. Now we move on to banking. What is a bank? Bank is a financial institution providing financial services to the general public on the way of accepting deposits, granting loans, and other functions. Or there is another definition of bank, that it is a financial intermediary which intermediaries between two groups of people, one group which has surplus money and the other that is in need of money. So the people who deposit their excess money in banks are one with the surplus money, and the people who are taking loans are the people who are in need of money. So, banking. What is the definition of banking next? Banking has been defined as accepting deposits for the purpose of lending on investment and deposits of money from the public which are payable on demands with withdrawable by check, order, or otherwise. So banking is basically the function that banks perform, like accepting deposits and granting loans to people who need it. So there are actually two types of banks that we are going to study about. That is our central bank, and there's our commercial banks. Central bank does not interact with the general public, but commercial bank interacts with general public. And commercial banks are also of two types, further divided into two types, which are scheduled commercial banks and which are non-scheduled commercial bank. Scheduled commercial banks are those banks which have been scheduled by the government, and they enjoy higher status than the non-scheduled commercial banks. So they are basically registered and recognized by the government. So what is exactly there are a few important points about banks, which are like commercial banks. The rate of interest at which the commercial bank accepts deposit is known as borrowing rate. The rate at which the banks lend to the investor is called lending rate. So it's very fairly simple that accepting deposit is known as borrowing rate. So they basically borrow money from the general public, and the rate at which they lend money is called lending rate. So there is another very important topic that explains how commercial banks exactly earn money. Like commercial banks are there for the purpose of profit making. They are not a government institution. They are not very socialist in nature. So the difference between the two rates is known as spread. So basically, if I am depositing my money with commercial banks, they gave me a 4% return on that, like the 4% interest on my deposit, but they lend it at 8%, at 10% interest rates. So the difference between the 4% and 10% interest rate is known as spread, which is basically the profit of commercial banks. Then we move to central bank, which is the apex bank of India, and it is different in other countries. Like it is known as RBI in India. The bank, which supervises, regulates, and controls the activities of commercial banks as well as other financial institutions, is known as central bank. Its special responsibility is to design and conduct monetary and credit policy. So it basically controls the money market in India and in their respective country. There are various functions of central banks, so I'll go read each function one by one. First, monopoly power of note issue. Only central bank has the power to issue currency notes. While issuing notes, the central bank has to follow a system in India which is known as minimum reserve system and proportional reserve system in America. So this system has two names, which is in India it has minimum reserve system, and in America it is known as proportional reserve system. The second function is it is the banker's bank. Central banks acts as a bank for all commercial banks. Commercial banks are legally bound to keep some amount of cash reserve with the bank, and central bank lends to commercial banks as the lender of last resort, which is another function of central bank. Again, the bank is the banker to the government. Whenever the government has excess reserve, it deposits the money with the central bank, and when the government is in need of money, it takes a loan from the bank, and it also lends money for various government projects. Then there is another function which is known as guardian of money market, which it's I explained it before that it acts as a guardian to the whole money market, where it decides the interest rates, the repo rate, the reverse repo rate, which are the monetary instruments which I'm going to be explaining in the further section of this video. Next, it is the custodian of foreign exchange reserve. All the foreign exchange earned in an accounting year is kept in the safe custody of the central bank, and central bank creates a BOP account, which is balance of payments account, which is again another chapter in our class 12 syllabus, which I'm going to be posting a video about. To bring economic stability, central bank has the responsibility of maintaining the economic stability in the country, which is inflation, recession, depression, all that situation are efficiently controlled by central banks in various ways. Then there is credit control. Controlling of credit is a step or function by central bank under its monetary policy for ensuring economic stability. So monetary policy is the policies of the government regarding the money supply, interest rate, and the availability of credit. So there is a very important topic of credit creation that I'm going to be explaining with the help of my blackboard. Okay, let's just first go over that. Okay, so commercial banks create credit on the principle that every deposit creates a loan and every loan creates a deposit. So that is a very, very important line if you want to like score well on a question on credit creation. You should add this line, like that goes every deposit creates a loan and every loan creates a deposit. There are some pointers that I would like to read one by one. When some people deposit money in their respective bank account, the same money is used by the commercial bank to lend it as a credit or loan, advances to other borrowers. But banks cannot use the whole amount for lending. That is, the whole deposit amount cannot be used for lending purpose. It is legally compulsory for the banks to keep a certain minimum fraction of their deposit as cash. This fraction is known as legal reserve ratio. Legal reserve ratio is again divided into two basic parts, which is known as CRR, which is cash reserve ratio. It is a part of the total deposit received by the commercial bank, which is required to keep. to be kept as a deposit with RBI. So this part of deposit is kept with RBI. And second is SLR, which is statutory liquidity ratio. It is that part of total receipts which the commercial bank are obliged to keep with themselves. So, before starting the concept of credit creation, let us assume that the entire commercial banking system is a single unit called bank. So, it doesn't matter which bank people deposited into. The When we study about process of credit creation, we are assuming that it is a single unit known as bank. So what I'm going to do is, this is a table of credit creation, and I'm going to explain the process of credit creation using this. So before we start the process of credit creation, as I said, we assume the whole banking unit to be a single unit known as bank. Suppose there is an initial deposit of 100 rupees by someone in the bank, and the LRR here I have taken and I have assumed it to be 20. So the banks are now free to use the remainder of of the deposits, that is 80, because 20% of 100 is now kept at LRR, like the CRR and SLR respectively. Then this 80 rupees is now given as loan to the other money seeking units, that is loan seekers. Now this 80 this 100 creates an LRR deposit of 20 and a loan of 80. This 80 is then given as loan, which is again spent by someone, and it's deposited to their bank account, and that is again a deposit of 80 rupees, out of which 20, that is 16, 20%, that is 16 of 80 is kept as LRR. Then 64 is again used to grant further loans, and this goes on and on in the further round. As you can see, 64 is the next amount of loan that could be maximum given, and after that, it's 64's 20% is 12.80, which is kept as LRR, and 51.20 is granted as loan. Now the process of credit creation comes to an end where the total deposit amount is equal to the amount of money multiplier, which I would be explaining after some time. And LRR is 20% of this amount, and the total of LRR is 20% of this amount, which is 500, 100, and loans are 80% of this amount, that is dependent totally upon the amount of the percentage of LRR which is taken. As you now saw the process of credit creation, where I took an example. Now let's go to the process of money multiplier, then we'll jump right back into the process of credit creation. What is money multiplier? Money multiplier is how many times of the total deposit would be of the initial deposit. That is defined by the LRR, that is determined by the LRR. The multiple is called the money or the deposit multiplier. It is given by the formula money multiplier, that is 1 by LRR. In the above illustration, that the illustration I gave before, the LRR is 0.2, which is 100 by 20, that is 0.2. Therefore, money multiplier will be 1 by 0.2, which would be 5. The total money creation is equal to the initial deposit. The total of the deposit amount that is to be found is this formula is used in that, which is initial deposit into 1 by LRR, which is initial deposit into the money multiplier. 100 into 1 by 0.2 is 500, which was the total of the deposits column in the previous example. So there is a relation between the LRR and the amount of deposit, the money multiplier, the credit creation process. So the lower the LRR, the higher the money multipliers, and more the LRR, the lower the money multipliers. So there is an inverse relationship. There is seen to be an inverse relationship between the amount of LRR and the process of credit creation. So there are we are done with this very important topic of credit creation and money multiplier. We move on to the last topic of this chapter, which is methods of credit control. So there are two types, there are two methods of credit control used by RBI, which is quantitative and qualitative. First, we move to quantitative. Quantitative methods are basically methods like the interest rates and all the techniques that is to be imposed and is compulsory to be followed by the commercial banks no matter what. So examples of that are bank rate, open market operation, cash reserve ratio, statutory liquidity ratio, repo rate, and reverse repo rate. All quantitative techniques are decided by RBI and is compulsory by all commercial banks to follow. So let's understand each method one by one. Which we'll first go to CRR. It refers to the minimum percentage of total deposits of receipt to be kept by commercial bank with the central bank. A change in CRR will affect the lending ability of the commercial bank. In the situation of inflation, to curb inflation, RBI will increase the CRR, so the lending capacity of commercial bank reduces. So the money creation, the deposit creation, the commercial bank would be able to grant less and less amount of loan, so there would be a lesser and lesser money supply, which would help to curb inflation. Next topic. In the situation of recession, the RBI would do just the opposite. It would decrease the amount of CRR, and the lending capacity of commercial bank would increase. SLR, that is the minimum percentage of total deposit received, which commercial banks are commanded to keep with themselves in liquid form to meet the immediate withdrawal requests of customers. An increase in SLR decreases the ability to create credit and vice versa. It has the same effect as CRR, as explained above, on inflation and deflation. Bank rate, which is also known as discount rate, it is the rate at which the central bank lends money to the commercial bank to meet their long-term needs. RBI uses bank rate to control credit, and it has the same effect as that on repo rate. Okay. An increase in the bank rate, it reduces the ability to create credit and vice versa. It increases the cost of borrowing from the central bank, which leads to increase in the lending rate by commercial bank. It discourages the borrower from taking loans, which reduces the ability of commercial bank to create credit. Now we go to the fourth measure of credit control. Fourth measure of credit control, which is repo rate. It is the rate at which the central bank lends money to the commercial bank to meet their short-term needs. So bank rate and repo rate. Bank rate is for long-term needs and repo rate is for short-term needs. Here the loan is granted against approved securities from commercial bank, and increase in repo rate increases the cost of borrowing from central banks and vice versa. Now we come to the second last topic, which is reverse repo rate. It is the exact opposite of repo rate. It is the rate of interest at which commercial bank deposits their surplus money with the central bank with a relatively shorter period of withdrawal. It is the rate of interest at which the central bank accepts deposit from the commercial bank. When reverse repo rate increases, it encourages commercial bank to deposit their fund and vice versa. The last one is open market operation. It means buying and selling of government securities in the open market or the general public. Open market provides a platform where the government bonds and securities are being traded with the general public. During the period of excess demand, which is inflation, the central bank sells the securities of government bonds and securities to open market, where more funds, where more currency can be absorbed by the central banks and vice versa. Last topic of this whole unit is qualitative measures, which are fairly simple. So there are two qualitative measures, which are margin requirement and moral suasion. So moral suasion is the combination of persuasion and pressure that the central bank applies on the other banks in order to get them fall in line with its policy. So qualitative measures are not compulsory to be adhered with, but quantitative are compulsory to adhere with. And the second qualitative measure is margin requirement, which is the difference between the security, the collateral given by the um, loan taker, and the amount of loan granted. So if I want to take a loan of like 70,000, so I would have to give them an asset of 1 lakh. uh, the margin requirement of that bank, the margin requirements change according to the bank. So the margin requirement of that particular bank that I want to borrow from is 30%. So I would give them an asset of like a security of 1 lakh, and they would grant me a loan of 70,000 instead, because the 30,000, the difference of 30,000 is the margin requirement that needs to be kept as an assurance that I would pay back my loan. So we're done with this whole unit. I hope you understood a little bit. I would try to make my videos better. I would try to explain it better. And if you have any comments, if you have any suggestions, please drop it below. And bye.